guys, welcome back to the Capital Mindset Show. So today I got something a little special for you guys. It's a triopoly of stocks. We're going to be going over 3 different companies that all compete with one another. It was kind of heavily requested in our request section. So I'm going to be covering all 3 of them at the same time. And I think it's pertinent because of the timing of what's going on right now, and they're all kind of crashing. So maybe you guys are interested, or maybe other people are interested in these kinds of companies. So I'm going to be covering them today, and that's Carnival Cruise, Royal Caribbean, and Norwegian Cruise Lines. So also I'm going to be unveiling a newer version of the model. It's far more extensive. So basically, remember, I always say that you guys are the artists, investors, we are the artists, and then we can develop tools that make the art a little bit easier. It won't make us on its own great investors, but it does make our lives a little bit easier, and we'll kind of show some of the new features today. So with that being said, I think I have pulled up first a discussion about Carnival, because Carnival is going to be the biggest one, or is the biggest one of the bunch. And we can see here that they've been dropping quite heavily over the past couple of days because of the new variant, right? And then we take a look over here at the 5-year chart, and we can see that it's crashed significantly since its all-time high is about 74%. So I think I'm going to take advantage of this moment and explain something real quick, a cautionary note that I think everyone should kind of be aware of. And this is kind of like a case study or a lesson for other stocks if you see this happening to them as well. So basically, if the stock price falls like this, it doesn't always necessarily mean that when the company recovers per se, that it's going to reach those stock prices again. So a very simple way of kind of understanding this is the share dilution that's gone or that's happened within these companies. So we'll go into the model and we'll actually see that in numerical terms what's happened. But basically, if you're sharing the pie with more people and you recover, like let's say in a mathematical example, the company is making $1 billion a year. There's 100 shares. Okay, then now the company's making $500 million a year because of something happening, and the company in an emergency issues 200 new shares. So now there's 300 shares in total. So when the company recovers, the value won't be the same as it once was. There's permanent damage because, well, permanent in the temporary sense, actually, so it's not permanent, but in the moment of that share issuance, you're now sharing the pie with more people. So once it's recovered, it's not the same company that you had when the bad event didn't happen. So when we're back to $1 billion, you're dividing billion by 300, right? Instead of $1 billion by 100. So that's something you guys have to be kind of cautious about. And if you see other creators out there who for whatever reason may be saying that the company will recover to where it once was, simply when cruising comes back online, are not paying attention to the share dilution, which I know for Carnival has been extensive, and it'll be kind of like a raw experience when we look at Royal Caribbean or Norwegian. So basically, that share issuance may have caused what I'm going to call permanent damage. It's not technically permanent because it could always buy back shares in the future, but for the sake of argument, it's kind of like what I'm trying to say. It's structural damage. It's something within the story has changed drastically. And Carnival being the largest, we're going to see some of the advantages they may have, but it also means that they have a lot of liabilities that they have to keep track of, okay, and that they have a lot of obligations. Norwegian, I think, is the nimblest of the 3, or not. I know it's the nimblest of the 3. But Royal Caribbean, for a lot of people out there, they tend to think of them as like the more higher quality company, and we'll actually take a look at why that is. I think there's maybe a little bit of leeway for debate between Norwegian and Royal Caribbean, even though Carnival Cruise is the largest, but we'll get into that. So actually, I think we should dive right into the model, because otherwise it'll be a 3-hour-long video. So real quick, let's actually type in CCL. Okay, so we already have the 20% required rate of return. Let's actually bring that down to 10%. So I'll go ahead and showcase some of the new features. So now I've added a feature that allows me to calculate weightings, right? Or how much I should put of my portfolio if I decide to buy it. And it's doing so based on the mathematical results. It's doing in the background. I won't get into that in this video, but I can either choose to do a custom weighting, or it will do a standard weighting of 20% across the board. In this case, I'm going to choose to just 20% across the board. And then now I have to decipher what are the growth rates going to be in the cash flows. Right over here, I've also added a feature that we can see if it's not profitable, we can normalize it over time. And we can see that over the average has been, or not the average, the highest a Carnival cruise has ever achieved is a 13.65% cash flow margin. So I'm assuming a 10%. And I'm assuming 10% across the board to kind of keep things the same. But arguably, if I wanted to be more detailed, I would be more precise with each of them. So, but I'm assuming 10% for all of them. And actually, we have a new feature down here in the recovery calculator, which is basically helping me pencil out what the growth rates I can assume. And then from there, I can model out what I'm thinking. So for example, let's say you want to assume that Carnival Cruise is going to recover or have some semblance of recovery. Before there was kind of like a more simple calculation, but it wasn't really being as precise as this one is now. So this one's actually going to tell you, or tell me in this case, if I think the company will recover in 1 year, and then I want to assume, for example, what is the average growth rate I want to measure. So I took the two years going back 5 years. So the first 2 years of going back 5 years, and I can change this to 3 years or 4 years, I believe. I think if you take in 4 years, it takes into account the decline. Yeah, you see, so we want to take about 3 years. If you want to normalize it out, that's why you put the option in there, because in some cases, for example, I want to remove an event such as the pandemic. And if I put 3, I'm removing the pandemic. So it's telling me, okay, it's the average around that time period was 8%. And if we're going to choose a number, I'm going to be consistent with the other two. So I'm going to probably stick to 3 in this case. And what it does tell me here, for example, is now if I say, for example, I think the company will recover in 3 years back to its normal levels. All right. So on the right, on this column right here, it tells me the growth it will need to achieve normalcy. And then over here, this is the growth rate I can assume for the entirety of the model, which is 10 years. And that would include the recovery period plus the average. And this is kind of like a post, right? So this is like where you can say, for example, if I think it's going to recover in 3 years, then the middle ground, or where I can, pencil out where it's going to be, is about 50%, if you believe that, right? If you believe it will recover in 3 years. So it's a tool. It's not going to tell you the answer. There's nothing that can predict the future, but it's a tool that allows you to visualize things. And then from there, make educated guesses on what you think might happen. So for example, I would say that the cruise industry may recover in 3 to 4 years. Okay. And I think that may be conservative, and you may think that's too conservative, but 3 to 4 years. So that tells me that for this company, I can assume a 50 or 48% growth rate. So that's going to be about my midpoint. And then that's averaging out over those years. And that's what I'm going to be getting. And that's including the average growth rate of 8.31%. And please feel free to leave comments down below if you have any questions about that. But I can try to explain a little bit what's going on in the background. So from there, I can say, okay, so let's say 50% is going to be my middle. And then if I want to assume lower than that, right? So let's be a little more pessimistic. Let's do 45. And remember, we got to be very careful, because this part requires a little bit of understanding what's going on behind the scenes and probabilities. So you don't want to say 20%, because the factor that it's expanding upon is going to drastically rise. Okay, so it's like a logarithmic effect. Okay, so it's or exponential, another way, if you guys get what I'm trying to say there. But basically, you don't want to go too low because it's going to have drastic effects. So like, for example, if I say 10%, you just, for argument's sake, you can see, right, it goes to $1.44 because you're basically saying it will never recover. If I'm saying 10%, it will never recover. So because the minimum that you have to assume for recovery in this 10-year period is 41.35. If that's actually the way I should have explained it first. But if I assume 41.35%, I'm basically telling the model it won't recover for 10 years, right? And that's what the math pencils out to be. If you average out the growth rate on that recovery, it's 41.35%. So 45 is pretty bad, okay? All things considered. If you think they're going to recover in 10 years, we're almost there. So let's do 41 as the most pessimistic. So pessimism is 41. And that's why I'm explaining this, because someone might say, whoa, you're assuming a stupid amount of growth. Well, I hope now that it makes sense why we're doing that, because we have to assume some semblance of recovery. 41% growth in cash flows is actually extremely pessimistic for this business, okay? Because it's saying, what you're saying there is it will take 10 years for Carnival Cruise to get to where it was before. And that may be the case, which is why I'm putting it in there. And then let's go a little more aggressive. So let's actually say perhaps it recovers quickly. And you see, that's another thing what I can use here is I can basically make different assumptions on recovery. So maybe I want to be a little more aggressive on the recovery. And I want to say, oh, it's going to grow at 55%. Right, so it's going to recover faster, and it's going to grow faster than it did before. People are going to have a fever for cruising. They're going to love it. And then maybe actually that should be my highest one. And then let's go with actually no, let's do it. Let's do like a 60%, because that let's really play out the cruise fever. And yeah, let's keep it like that. So now we can see at 10% required rate of return, these are the assumptions I can make. Now, this is the new feature I've been kind of working on, and there's actually more features yet to come. But here we can see that it actually already scrapes the different databases, and we can get the beta. So for example, we get beta, we get analyst ratings here. So over the videos, you'll be able to see, and we'll talk about it here and there. Price targets of analysts is 27.95. So now we can compare ourselves to the analysts. Earnings date is sometimes it will scrape it, sometimes it won't scrape it properly. The volume, on a given day, it'll scrape that. And then all the other stuff is really not that necessary. I'm going to be working on a way to actually grade the CEO and then like actually port that in. But that will take me a little bit. So the average growth rate over the past years, you see that one's taken all 5 years into account, so it's negative 27%. And I'm sorry for you guys that I'm explaining the new features a lot. Don't worry, the next 2 stocks will be very quick, but we're just kind of getting used to what are the new things, all these numbers. I have to reorganize and make it look a little nicer. I know that, so don't worry about that. So let's increase the required rate of return. And actually, yeah, geez, it's actually telling me to short it, the model, but that's what this basically means. It's telling me to short the stock, but I'm not going to be shorting the stock. And because either the assumptions are too pessimistic, and you might be again saying, oh, that's not very pessimistic. Well, remember, I tried to explain down here in the math like why that's actually not that pessimistic. Or sorry, optimistic, but like 60% growth rate going over 10 years, considering that they've had a tremendous drop. So you're assuming a recovery in there is not that big of a deal. All right, so if you want to assume 15%, there you go. 10%, it says based on all my scenarios, I should allocate about 2.42% of my capital to this position, no more nor less, because then it starts to address or say that it's pretty risky. I know that the model is telling me that it is at risk of bankruptcy, or there's a potential for bankruptcy, and that's probably because of all the debt they've been taking on. Do I think that that'll happen? I don't think so. But the model's just telling me to be cautious. Remember, it's a tool. It's not a crystal ball. There's no dividend. We can see here. Let me see. Book value per share 13. So nothing too interesting here. Let's look at the key ratios. And I'll give a sneak peek onto something that's working on right now. So basically, it can organize it all by sector. And these are apparently all the companies that are in the same sector as Carnival Cruise. There's Royal Caribbean and whatchamacallit, and Norwegian are both in here. But there's going to be like a new feature that I'm going to be able to kind of automatically extrapolate them, because this is kind of scraping in. As soon as I put in the ticker symbol, it just takes it out. So I'm going to have to put that and probably do a query formulas or something like that. But anyways, so let's look at the key ratios. And for the key ratios, to no surprise, or it shouldn't be a surprise to anyone, that everything's getting worse except for the liquidity ratios in the short term. But however, they've already just gotten worse. And I think for the most part, when we look at the other two, I think it's actually normal for this industry to have terrible liquidity ratios. So it's nothing to be concerned about. In fact, 2020 is an abnormality. And then we look at the solvency ratios, and solvency ratios seem to be okay. They've definitely gotten worse since the pandemic. So that's where you can see that debt has risen. And now the model is telling me, whoa, be careful. Bankruptcy risk. And then gross profit margins, they've collapsed. So we hope that they would normalize. We have to pay attention to that. And so far, we're just looking at Carnival Cruise. I'm going to ignore the inventory stuff. I don't really care about that for this company. Book value has collapsed. Okay, so if you think they're going to recover a lot faster than what the market thinks, and you think there's going to be a cruising fever among the population of the world, then this could be an interesting buy. But let's take a look while we're here at the other two. So let's take a look actually at the price action first of Royal Caribbean. I think we'll do that one next. And Royal Caribbean, again, some people have told me they think that that's the higher quality company. You guys may disagree with that. Please let me know which one you think is the highest quality in the comments down below. But you can see it's been a lot less volatile. It actually almost recovered. It wasn't too far away from the pre-pandemic, well, 43%, but relative to the other ones, it's not. And we'll see why. It's because they diluted less. So over the long term, we can see that. Let's actually put in Carnival to show the performance versus each other. And we can see here that Carnival has actually outperformed Royal Caribbean, but it's kind of unfair because Carnival's been in the game for longer. So if we normalize that, let's say over 5 years, then you see the different story. Royal Caribbean's outperformed Carnival. So again, the reason why Carnival's outperformed here is because you see this time period that they were public, that Royal Caribbean was not. That's years of compounding that weren't there. Remember, compounding interest is extremely powerful. Let's throw in Norwegian just for the heck of it, and so we can compare them all. And you can see that Royal Caribbean's been outperforming them all over the past 5 years. So that's where some people derive that statement that Royal Caribbean is the highest quality. Now, a lot of my friends have gone on Norwegian, and they've told me that that's their favorite as a customer, but I'm talking about from the company perspective. So going into the model for Royal Caribbean, let's change that back down to 10%. And we have to, let's take a look. So, okay, so price target is $95. So we're going to be going a little bit quicker now. Analysts rate it as a hold on average, and beta of 2.62. I think Carnival's was what? Carnival's was 2.14, so a higher beta. And what did I say I was going to use? I said I was going to use 3. So we're going to use 3 for all of them. So in that case, you can see here that Royal Caribbean has actually less to recover, right? And you can see that in this number right here. So this is 1,000%. I think Carnival's was 3,000%. So the recovery period is definitely better for Royal Caribbean, and they've grown on average at 8.8%. So let's start to assume, I think I assumed the 3% for Carnival. Yeah, I did. So 3-year recovery. So 3 to 4 year recovery. And so that will be about 42%. So let's do a middle of 42. And let's do a max or a high scenario of 60. Let's do a in between that of 50, 53. And let's do a low of, remember, we have to be careful on the downside because it's gonna get worse and worse progressively. All right, and then we'll do 40 in between that. Okay, so I think the 60 is a little too high. Let's do 55. Okay, so basically it does say, and I probably have to tweak these assumptions a little bit, in my opinion. I'm probably gonna have to tweak these assumptions. But it does say that we should probably not actually dedicate any part of our portfolio into this, even at a 10% discount rate. So what that's telling me right off the bat, remember, deriving story from the numbers, is probably Carnival is cheaper. And that's why the model is saying, okay, you can add some of it to your portfolio at current prices, and that's what it's measuring, by the way. It's measuring at current prices relative to what your assumptions are. And then it's doing that, measuring some risks. And again, it's only as good as your assumptions. So it's not a crystal ball. Now, what I would like to see here is, let's see the book value per share. Okay, so book value per share is 25. Okay, so no, yeah, Carnival is cheaper on a book value basis. So yeah, that answers that question. So Carnival is trading cheaper, perhaps because there's more perceived risks. So with a Royal Caribbean, let's actually lower that discount, see what happens. There we go. It's pure positive. So it's basically saying under all these assumptions, and if you want to make 5% per year, you should do it. Okay, so let's take a look at the average buybacks over the past years. You can see why the dilution was so much less. So let's go back for shock factor. Average dilution was 14%, almost 15% versus 5%. So a crazy amount less dilution at at Royal Caribbean than Carnival. All right, let's raise that discount rate because let's be honest, that's way too low. All right, so 8%. Yeah, I'm pretty much just right now playing around with these numbers to kind of show you guys. But if we want to raise this assumption, let's say to 43, you can see that the weighting now is up to 8%. Actually, that's interesting. Let's actually discount this at 10% now, though. Yeah, you see it's still at 10%. It says it really shouldn't add. I wouldn't short, but like it's saying that you could reasonably short at a value weighting of negative 0.28% of your portfolio. That's not a recommendation. I've said that almost like as if it was one, but no, it's not. So, but the analysts think that there's a 35% potential in this company, right? So they could be right, I don't know. They could be putting in some numbers that, I don't have. All right, so, oh, and I forgot to point out this feature. So you'll see this here in the background. So if I mess up on these custom weightings, so like, let's say I'm a goofball and I say that, it's going to insult me. But yeah, so it will tell me like here, like a little guide so I can not make mistakes. So I have to decrease this by 15%, or sorry, 5%. All right, let's go look at the key ratio so we can move on to Norwegian. And with this one, it's going to tell us a little bit of a different story. The theme is pretty much more or less the same. It's telling me that this is a company that had a one-time event in the pandemic and did some damage to their balance sheet. Relative to the other one, it's not that bad. Okay, Carnival's was a little bit worse on the damage front. I didn't cover the earnings quality on either of them, but the earnings quality has been decent and actually been really good for Royal Caribbean before the pandemic. So there you go. So I'm not the one who was actually saying that Royal Caribbean is a higher quality company, but I'm seeing it in the numbers. Let me go back to make sure. That's what other people have told me their opinions was about it. Okay, so no, actually both of them had the same earnings quality or about the same. I wouldn't really just say that Carnival's is worse or better. In fact, they might be, no, yeah, they're slightly worse, but nothing crazy. All right, so inventory ratios I don't care about. And then same thing with the book value destruction. Book value destruction everywhere for everyone. All right. All right. So last but not least, let's go to Norwegian. So Norwegian Cruise Lines is the smallest of the bunch, and they may be like the more niche player in the sense that they have like a cult-like following from what I know. But yeah, let's take a look at their price action. And we already saw them in comparison to Royal Caribbean and Carnival Cruise. However, in isolation, what happened to them? Let's see. So they're down about 66% from all-time highs. They didn't have that same down drop that Carnival had. Remember, Carnival was sloping downwards before the pandemic, and Norwegian just got destroyed by the pandemic. So I think we're done with that. Just looking at that. So let's take a look over here at the model. I already actually had it plugged in. And let's take a look at, let's remove these and let's actually lower this back down to 10%. And let's make this 3. All right, I'm remembering, guys. All right, so let's take a look at analysts. Analysts say this one's a buy. So to go back, so you guys don't have to go back on the video, let's take a look at what all the other ones said. So they said Royal Caribbean's a hold, Carnival Cruise, they said it's a hold, but they say Norwegian is a buy, right? Yeah, I just turned off my camera like a doofus. So Norwegian is a buy, and which is actually quite interesting. Let's actually explore why. Again, this is a raw video. I like to do these videos raw because there's no script or anything like that, so you guys can kind of see like, oh, how I look at a company, and then from there, hopefully it contributes in a positive way to how you guys invest. All right, so taking a look at the recovery period, again, I'm going to go with the 3%. So I'm going to assume a middle ground of 53 to 52. So we'll go with 53. And then, oof, right off the bat, not doing too good. So Carnival Cruise is the cheapest. That's what that's telling me. And probably because they did the most damage on the dilution end. How much did you guys do? 14? No, they did about the same. Look at that. Yeah, look at that. Exactly the same. All right, that's interesting. So let's go on a higher end. Let's go on a high end, like 60%. Let's be generous, because maybe everyone's thinking out there that I'm being too aggressive or too conservative. And then 50, well, let's put that at like, let's put this at 53. And this is 55. Then this is 57. Okay, just telling me to short it. It's telling me to short all these companies. All right, so 51%. All right. So this is what we have so far. So basically and let me just explain, I'm also normalizing the cash flows to 10%. Like I said, I'm doing it the same for everyone. And I'm not assuming dilution or further dilution in any of these. So what I'm kind of showing here, or what I'm seeing here, and I have no horse in this game. I do not own any of these shares, and but I hope everyone who owns it makes a ton of money. So just before we go further, but I do think that they look cheap, but they're not that cheap. They're not that cheap, and that's going back to that damage I was talking about. So that that added damage that they did with all that dilution is very powerful, and it's going to linger for a long time unless you start to assume some buybacks. So I'm going to go back through all of them and kind of do like a final run and show everyone what would happen if they, for example, bought back shares. All right, so if they started buying back shares, you see how the model, we can start get a little more aggressive here. And then let's go back to yes. And let's go to 5%. So you see Carnival would do actually, well, let's bring that up to 15. Yep, still not too good. And with a 15%, yes, and let's see what happens. Okay, no, Norwegian is the worst. So, well, again, I think we are assuming different growth rates for each one, but I think the highest growth rates was, yeah, Norwegian and Carnival. And I said Royal Caribbean would have the lowest growth rates. And again, to reiterate, in case you were skipping through the video, the growth rates are really high because of the recovery that we're assuming. Okay, so we're assuming a recovery. That's why we're averaging out the growth rates to be that. So that being said, in summary, all these companies seem to be a lot more risky than what people are kind of letting on. So, and maybe you guys have seen some content creators out there talk about these companies, and they might not have penciled out properly the amount of dilution that's occurred relative to what the performance might be. And even assuming very generous recovery periods, we'd have to assume not only would the market recover, but maybe grow way more than what they originally were doing. So it's a little risky for my taste. I think I'm going to do the airline companies as well as a follow-up to this. They weren't really requested, but I think they deserve a follow-up because it covers a different part of the travel industry. So this is more like the leisure side. And, you know, it's obviously different. We're talking about ships versus planes. But I think everyone will kind of appreciate that. We still have other videos coming out for those international stocks. I repeated this in the ASOS video. We got a lot of requests for international stocks. And so it gives us an opportunity to kind of explain some IFRS differences between IFRS and GAAP, and what you have to kind of look out for, because a lot of the free tools out there, they won't automatically correct all the time for IFRS. So the numbers that you get on the websites can be kind of funky, and then that can hurt your projections, because your predictions or your educated guesses on investments are only as good as your inputs. So I think that will be some good content to provide to you guys. If you guys have any questions on anything I've covered here in this video today, please let me know. So the final verdict for the cruise lines is, you know, they look cheap just on a visual basis when you're just looking at the chart, but when you really break it down and you see like, okay, what's under the hood? What are you really expecting from them? My growth rates may be really small. You know, again, there could be some cruise line fever that's going to happen when everything gets back to normal, and they're going to have greater sales than they've ever had before. Everyone's going to cruise, and so that's not penciled in. But if that does happen, then these projections are maybe too conservative. Or I'm being a little too aggressive by not assuming more dilution, because I wasn't. I was assuming no dilution on either of them. And then at the very end, I showed you guys what would happen if we assumed buybacks. And even with the buybacks, it didn't come out too nicely. I mean, it didn't come out to eye-popping, market-beating returns, right? And then if you're not aiming for that, if you're not managing your risks properly, you might as well go for the index fund, because the index fund is basically going to give you the market return, and there's nothing wrong with that at all. So it's just like being smart with where you decide to put your money. So for me, as far as my opinion, maybe we'll hear Austin when he comes back, his opinion about this, and he'll probably watch this video, and then I'll just ask him actually the next time he shows up what he thinks about the cruise lines. But if you guys like this video, please feel free to like the video and then comment down below any questions. I'll get back to you as quickly as possible. If you guys have any requests, put them in the comment section or throw them in the website, and we'll add it to the list, and we'll get back to you guys as soon as possible. All right. Thanks, guys. Have a good one.